From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. A call for the end of accounting as we know it by a leading business school professor of accounting. And then emerging trends in real estate from PricewaterhouseCoopers, leader of real estate research. It's a fascinating all accounting experts show today on Business Talk with Jim Campbell. Baruch Lev is the Philip Bard's Professor of Accounting and Finance at the NYU Stern School of Business. His co-author, Feng Gu, Associate Professor, Chair of the Department of Accounting and Law at the University of Buffalo. We're going to have accounting and fascinating is not oxymorons today on Biz Talk. Welcome, Baruch. How are you?
I'm fine today. Thank you. And how are you?
Very good book you read, very fascinating. Why don't we just get right down to it? What's wrong with financial accounting? Why does it matter?
Financial accounting matters a lot because this is supposed to be the information that moves market. That investors make decisions on the basis of this information. Money is allocated to companies with great potential to grow and produce beautiful things, and away from companies that are declining. And so this information is really the fuel that gets capital markets to work and economies to work.
And in fact, you do a lot of statistical modeling to back this up. You say that only about 5% of what comes out of financial reporting is actually relevant to investor, and there hasn't been much change in accounting in 100 years. That's pretty amazing, isn't it?
Yeah, the structure of accounting, I was amazed when I first saw it. Someone gave me the financial report, the first financial report of U.S. Steel from 1902, and I look at it, and it's identical to financial reports today. The same balance sheet, the same income statement, the same cash flow statement. I couldn't restrain myself when I saw this thing.
Not only that, but as you point out, U.S. Steel was incredibly successful in 1902 and not so much recently. But you can't really tell from looking at the reports which is successful and which is not. Tell us, we're really going into the information age. The balance sheet reflects typically plant and equipment, inventory, tangible stuff, but really the values in intangibles. Talk about that.
Yeah, there has been in the last 25, 30 years an incredible transformation in the business models of companies in the United States, all over the world, but particularly here. Just to give your listeners an idea, the total investment in intangible assets today, meaning in patents and brands and information systems and human resources, it's $4.5 trillion with a T. $1 trillion, and it's twice the investments in things that you can touch and kick, like plant and machinery and inventory. This goes down and intangibles go up, but accounting still reflects the tangibles, the physical assets, proudly on the balance sheet, but these assets don't create any value anymore.
Fascinating. You also are critical of all the management estimates that go into reports. I was interested even to see that sometimes the revenues line are estimated, which people think are pretty predictable or at least definable, and that business events often, such as product failures and things like that, are not highlighted enough. Those are also key factors, right?
They are key factors, and I call it sins of omission and commission by the regulators of accounting. Omission, not adjusting for this incredible transformation of how businesses operate today, and commission, meaning that in the last 15, 20 years, practically everything that was done in accounting regulations, in setting up the standards for financial information, involves estimates, projections by managers. They are more and more difficult to do. Sometimes they are even manipulated. So people, when they think about accounting, they all heard that accounting is boring, but at least they think it's factual. After all, accounting comes from counting money, counting inventory. But today, accounting is primarily based on estimates, projections, which decreases significantly the reliability of the information. And all this leads to our estimates of about 5% of the information in those 200-page reports relevant to investors today.
Pretty amazing. Quarterly profits is another thing that I've always thought were overvalued and maybe not even offering much value 3 months in a corporation's history. They lend themselves to insider trading as folks try to get information out of Wall Street. It incentivizes corporations to try and manipulate to hit the goals, etc. What do you think of quarterly profits?
This is just something amazing. This is something that both managers and investors are obsessed about, which is, as you mentioned, hitting the targets, hitting or surpassing the consensus earnings estimates, quarterly earnings estimates by financial analysts. And we recently, Feng Gu and I recently calculated that even if you could predict for sure all the companies that will beat the consensus, surpass the consensus, and all the companies that will miss the consensus, you will hardly make any money based on this.
I think you also said in the book that 70% of the companies tend to hit the consensus, which would raise some eyebrows, wouldn't it?
Yeah, it's a game, and it's a totally unproductive game.
Exactly. Let me ask you about this. Results now more and more are issued sort of in a non-GAAP or pro forma basis because they say there's all these one-time things. And I looked this up because I thought about it. IBM always has these big restructuring one-time charges, but they've had them now for the last 7 years in a row, ranging from $450 million to $1.5 billion per year.
That's a very good question, but let me just make your listeners aware that we are talking about two things when we call it non-GAAP information. One is the one that everyone focuses on, and that's non-GAAP earnings. So these are the adjustments that you just made, taking out one-time items, restructuring, and so on. This, in my mind, is of marginal importance. What is of great importance is the avalanche of information, non-GAAP, meaning voluntary information, that companies report. I'll just give you two examples. One is all pharmaceutical and biotech companies report their product pipeline, meaning all the projects they are working on, at what stage they are, what is the target market. This is invaluable information to pierce the future. All subscription-based companies like internet, telecom, media, insurance companies, all of them provide lots of non-required information about their customers. New customers, the churn rate, how many are leaving them, customer acquisition cost. This, in my mind, not the non-GAAP earnings, but this kind of information is extremely valuable because it talks about the business model of the company. What lies ahead? So we have to make a distinction between the few tweaks to earnings, some of them are manipulated, and the really important information that comes out outside the regulated system.
So essentially non-GAAP earnings can be of more value. Let me ask you about this. We had this huge financial crash in 2008. Asset valuations on the balance sheets ended up being basically fictitious, overstated on Wall Street. What about that, too?
That's just one additional failure of the accounting system. Because the accounting system is supposed to warn investors ahead of time of things to come, like in the case of the financial crisis, of huge increases in the riskiness of the assets of financial institutions. That's the idea of a good information system. Not that it looks back, it tells you something about the future. And the system, of course, completely failed. No one had an inkling that banks and investment banks are piling and mounting extremely risky assets. You read the balance sheet, and it didn't give you an inkling on that. A big failure.
You're listening to Business Talk with Jim Campbell over the Business Talk Radio Network, 350 stations around the country. Go to biztalkradio.com, find the station nearest you, listen over the Internet, access our podcast of shows. And coming next, our final segment with Baruch Lev of NYU, we're going to talk about the path forward for adding value to accounting for investors, some of their radical recommendations for change. We're back with NYU Stern School of Business Accounting professor Baruch Lev, and tell us about the path forward, how you recommend bringing accounting into the information age, and I know you've got this strategic resources and consequences report that changes everything the way it's looked at.
We approach this issue the same way we approach the first part of the book, as basically as scientists, and rather than presume to know what investors need, we carefully examined hundreds of conference calls, those quarterly conference calls that come an hour and a half after the earnings release, in which analysts, investors have a unique opportunity to ask managers questions. So we studied hundreds of those conference calls to understand what are the information needs of investors, and we got a pretty good picture. They basically want to know about the business model of the company. What are the major assets that create value? We call them strategic assets. How are these assets deployed? What kind of value you get from these assets? And around this, we structured a new report, which we call Strategic Assets and Consequences Report, which focuses on these assets. So the assets are, for example, patents and trademarks for pharmaceutical companies and the customer franchise for telecom and internet companies. And the important thing is, how much do you invest? How do you protect them from imitation? And how you deploy these assets? You mentioned IBM before. IBM is an incredible innovator, and they get like 10, 12 new patents a day. The question is, how do you deploy this asset? How many do you develop internally? How many patents do you sell? How many patents do you license? These are the questions that investors are asking and want to get answered, and nothing of this appears on the balance sheet.
In fact, you talk even about separating the R&D out, research and developing, as being two very, very different things that need to be evaluated in different ways, right?
Yeah, this is extremely important information. The R basically means basic research. This is the inventions of new technologies, new system. And the D is development. It's improvement of current technologies. It's basically tweaking things that we know how to do already.
These are all great points. Another great point, I think, is that may seem a little complicated, but it's basically a business only creates value if its returns are higher than the cost of its capital. And you actually have a value creation metric, right?
Yeah, that's we propose a new measure, and not just propose as we do all along the book. We show that it performs better than others. This is basically based on cash flows. We talked before about managers' estimates and projections. Cash flow doesn't have many estimates. We back all the expenses, accounting expenses on intangibles, on R&D, and so on and so on. So if you think about Cisco, they have $50-60 billion of equity. This is shareholders' money that they are working on. It's not free money. You have to earn the privilege to operate with this money, and that's the cost of capital. So after subtracting the cost of capital, we get a measure, a much more real measure of value creation. And we show that you can gain from this measure more than from just earnings or even cash flows by themselves.
And as we say again, none of this information appears as required reporting as of today. Now, short-termism is another big problem. We talked about quarterly. Firms do use financial buybacks, stock buybacks, and things like that to sort of engineer earnings. You're actually recommending, and this is pretty radical too, abolishing quarterly reporting requirements.
This is the boldest recommendation in the book. And I talked with lots of people about it. They have very different opinions. Some are excited about it, particularly managers, somewhat less, because they somehow learn to live and work with quarterly earnings. I know that the UK is a substantially smaller economy than the US, but it's a very vibrant economy with a huge capital market. UK firms report just twice a year, every 6 months. And I don't see any calamity in the UK because they don't have quarterly reports. The damage of quarterly reports, as you mentioned, is huge. It's this obsession with the short term all the time that managers and investors waste on something which could have been diverted to more productive things.
As we get down towards the last couple of minutes, this stuff, you can see how much value this is to investors down to actually showing them what is created as incremental value. How do you think this gets implemented?
It's not going to be easy because no significant regulatory change, and that's what we are proposing, is easy. But for investors, they don't have to wait until regulators will wake up and change the accounting system. As I mentioned before, and we give numerous examples of this in the book for 4 major industries, much of the information that is required for our strategic resources and consequence report is already disclosed by companies. It takes some time to get it because some of it is in conference calls, some of it is in presentations to investors, some of it is in the management discussion analysis report. So it's less efficient than it would have been provided in one report, but it's already given. And if you spend the time, you can get a pretty good idea about what the company is actually doing and what lies ahead instead of what happened in the past.
I find it interesting that you almost have to be a detective to find out how companies are really doing. Do you think management will go along with this? I mean, right now you get these beautiful annual reports with all these pictures in them, and you can't really and they make it seem like the business is doing great no matter what.
You're perfectly right. Not all managers. Many of them are quite happy with the current system. Many of them are not that disturbed that the financial report don't provide great transparency. They don't love transparency to begin with. So not all managers. Some do because they understand that the better the information, the better the consequences. More money will flow to their company. Share prices will be higher. Their compensation will be higher. So those who can see somewhat further understand the value of better information. Others are comfortable with the current system.
Well, this has been a fascinating interview, and as I say, to make basically change the whole structure and the current form of financial accounting reporting. Baruch, tell folks the name of the book again.
The book is called, the sensational title, The End of Accounting. And the path forward. The end of the accounting is only the beginning. The path forward for investors and managers.
And I promise you, it is not boring. It is fascinating, and it is exactly what Wall Street needs to move towards. And now, coming up next, we'll have our second half of Accounting Experts. We'll talk with the partner from Price Waterhouse about their emerging real estate trends report. Baruch, thanks a lot for your time. Good work.
Thanks, Jim. Great questions.
Appreciate it.